Welcome back, everyone. I'm going to be discussing the bullish synthetic options trading strategy. What is this strategy and how does it work? And when should it be applied? You can trade this in any company where you think it's going to go up in price. So I'm going to be using 3M strictly as an example. Let's say you have some sort of a forecast for whatever reason it may be that this stock is going to go up in price. So let's say you see an inverted head and shoulders. Here you have a bull flag formation, and the price has eclipsed the 50-day and the 150-day moving averages, and it has closed above both of those averages. So you think the price is going to go up from this price. So what trading strategy could you use in terms of options? Well, you can buy a call option, and that would be an investment that would have unlimited potential to make money, and of course, limited to the price you pay for the premium. However, it's a high risk trade because it does have an expiration date. So you have to not only be right, but you have to be right in a certain period of time based on the option's expiration. So that's risky because you could lose the whole premium. You could just go out and buy the shares. You could buy 100 shares. When I say 100 shares, I mean, the reason I'm saying 100 shares is because the rule of options, it's always one option equals 100 shares. That's the way it works with options. So if you buy 100 shares of a $100 stock, it's going to cost you $10,000. Now, what if you don't want to put up all that capital? Let's say you don't have that kind of money to put up, but at the same time, you want to benefit from an unlimited potential of gain, yet put up a lot less capital from your account. So the way to do that would be a bullish synthetic strategy. So here's how it's going to work. You would buy a call and sell a put at the same strike price with the same expiration date. You purchase the call, obviously, as I mentioned before, the risk is you could lose the entire amount if the price goes down. However, by selling the put at the same time, at the same strike price, you are financing the cost of the call with that put option. So what's happening here is you're entering the trade with no cost. It doesn't cost you anything. When the call expires, the put pays for it. However, this is a very risky trade because if the price goes below the strike price, however much it goes down, it could go to zero, and that's how much you could lose. So the risk is very, very big here. You could actually lose a lot more than the money that's required to put up to take the trade by the broker. Even though they require you less to do the options trade, you could actually lose more than that amount if it goes to zero. Even if the price does go up. So let's say it goes from 100 all the way up, it's going up, it's going up. These options expire. So let's say you choose a 30-day or a 40-day or a 60-day or an 80-day expiration date. Even if the price is going up, you're going to have to roll it over, which means you're going to have to roll it over to the next month. So let's take a look at what that looks like right here. I'm actually going to enter this trade. That's the other way it works here. It's going to be at the money. So we have to get something as close as to where this closed, which was 99.85. Okay, so I'm going to show you how to enter this trade using the thinkorswim trading software. So right here is the option chain. So we're going to choose a 48-day expiration date and the 100 strike price. That's the closest to where the price is right now. Now, as you can see, I wouldn't take this trade because the fact that the put option premium is lower than the call option premium. So in order for this trade to work, it has to be either exactly the same or the put option premium has to be higher, which of course is even better because then it leaves you with a credit. So you actually get paid to take the trade. It actually makes money right at the beginning. So that would be great. In this case, you can't take this trade because, as you can see, the premium of the call is higher than the premium that you receive from the put. Because when you're buying the call, you're spending money. And the whole point of this trade, to make it a free trade towards the beginning, is that the premium that you receive from the put will compensate you for the premium that you pay out for the call. In this case, that doesn't work, but we're going to enter it anyway, just to show you how it works. Okay, so I'm going to choose a 48-day expiration date and 100 strike price. So that will be right here. When it says buy, as you can see, the tooltip shows buy, you just click that. Now the next thing you do is hold down the control key on your computer, go over to the 100 strike, right here, overlay it, right click, and go to sell, single. Okay. So here's the trade. It's saying debit because, like I just mentioned before, you're paying out more for the call. We're going to change this to one. Let's say we're just doing one option. Just click there. Okay. Change that to one right there. And then you just go to confirm and send. Now, as you can see right here, if you bought the shares, you will be paying around $10,000. Of course, that's the max loss because that's the most it can go down to zero. But take a look at this. See, the broker is only holding $2,322.50. So that's just about 1/5 of what would cost you to actually go out and buy 100 shares of 3M. So that's the benefit really that you get here. It's really the only benefit you're getting. For smaller accounts, if you don't have $10,000 to put up for the trade, you put up a lot less by doing their strategy. Now right click, go to analyze trade. As you can see, here's the profit loss graph. You see, this is zero. Anything above here is profit, anything above here is loss. As you can see, it's straight up. As the price goes up, there's your profits. See, it's 100, goes to 101. This is basically supposed to mimic as if you would buy 100 shares. Now, keep in mind, there's certain things you have to know. There's an unlimited amount of loss to zero, just like you would buy 100 shares. So it's the same thing. As it goes down below the strike, you're going to lose the same amount of money as you would by owning the shares itself. Now, here's the other thing you should know. This trade expires. So when it expires, you have to roll it over. Even if the trade is going your way, and if it goes up above the strike price at expiration, the put that you sold is going to expire worthless. You keep all that premium. However, if you continue to hold past expiration, the call option is going to be exercised. Now, the point of taking this trade is because you don't have the capital to cover $10,000. Well, you will if you get exercised at the 100 strike. So if the price is 105, 110, wherever it may be, you're going to be long 100 shares at $100, and that means you have to put up the amount of money required by the brokerage house, which is $10,000, unless it's a margin account. But the bottom line is it's going to be more than what you have to put up as if you would do the bullish synthetic strategy, which is only 2,000 and change. So you have to know that. So you have to exit this trade before expiration. So if you want to hold on to it, you have to roll the position over, meaning you just have to go to the next following expiration date option. You would have to buy back the put, sell the call that you bought, and then go to the next expiration date, same strike price, just further out expiration date, and just buy the call again and sell another put. And then you could just continue doing it if the trade is going your way. Now, if the trade moves against you, if it goes below 100, right, and you start losing money here, it's just like owning a stock. So you have to have an exit strategy. The question is, how much are you willing to lose? Are you putting a 5-point stop, a 10-point stop? Is it going to be a 95, 90? That's entirely up to you because it's the same thing as owning the shares. Again, the same thing. So again, it's also time sensitive. You can't hold this to expiration because that's the worst thing that can possibly happen. If this moves against the 100 strike and goes lower, however lower it goes, you have unlimited losses to zero, because what's happening here is the call option expires worthless because it's below the 100 strike, then the call option would expire worthless. And now the put option is going to be exercised. So that means, in this case, you are going to be long. And that means you're going to be assigned 100 shares of 3M at $100. So if the price continues to go down, you're going to lose dollar for dollar. So that means if it goes from 100 to 99, you lose $100, 98, $200, $300. See what I'm saying? It keeps going down and down. So that's what's going to happen here. So that's why you have to get out of this trade before expiration if it's moving against you based on how much risk you're looking to take, as if you actually own 100 shares of the stock itself. There's something else you need to know here. It is a two-leg strategy. And if you take a lot of positions, let's say you do more than one option, right? You have several, it's going to be commission intensive. A lot less as if you bought the stock. A lot of brokerage houses now have free commission with stocks. Options, not the case. So if you're trading and paying commissions every option that you're buying is a commission on both sides for the call and the put. So it could be commission intensive. You put on multiple positions. That's something else you have to know about this trade. So in reality, the only benefit to this trade, the only benefit to this strategy is the fact that you have to put up a lot less capital. Right? There's a lot less capital involved here. And I mentioned before, it's commission intensive because it's time sensitive. As they expire and you want to continue to hold it, then you would have to close this position, then open up another one. So there's a lot of commissions right there. It's time sensitive either way. This strategy has to be exited, whether it goes in your favor or it doesn't go in your favor. You have to get out before, and that causes it to be commission intensive. You have to also monitor it, make sure that you're out before the trade, because either way, it can cause problems. Even if it's going your way, that means that you're now going to be assigned shares based on that call option. And then moving against you, you also have to get out as well, and you have to have a stop loss order. Now, you can put a premium stop loss, or it could be a psychological stop loss, but that means you have to monitor this trade and pay more attention to it. That's not going to guarantee you getting out where you want to get out, because options are volatile, slippage, so it could be more time consuming as opposed to just the stock where you can set a stop loss. I mean, you can get slippage in a stop loss if the stock gaps down or something like that, but there's more of a chance you'll get a better fill with the stock than actually closing a two-legged option. So that's the other issue with this trade. There's a pro to this trade and there's several cons to it. Okay, you just go to confirm and send. So as you can see, this is the only pro to this trade, the fact that you're putting up very little to get unlimited profit potential. Now, so obviously you wouldn't take this trade because you have to spend $54.30, which would be a debit. See right here. Generally, you should get a credit, but since the call is costing more than what you're receiving for the put, therefore it's costing you to take this trade. Now, if you really think this is going to go up, if it's just going to be a cost of $54 for you, and the benefit is that you're only putting up 22.50, 2,000 and change. I mean, instead of having to put 10,000, and you really think this is going to go up, like this is really going to go up, and you don't have enough capital to buy 100 shares, you might want to consider taking it, because that's the cost of doing business. I mean, you could just look at this as kind of like a commission, part of the commission. It's only $54.30, and you're controlling 10,000 shares. So if the price goes up, and especially if it goes up substantially, this can be a really good trade for you. Just go to send. Now the market's closed now. In general, you would see it right here in your monitor tab. See, there's the trade itself. So I hope you found this lesson beneficial to you. If you have, please show your support for this channel by subscribing. Feel free to leave comments. Please like up this video, and thank you for tuning in.